As traders, we usually prefer to take trades when there's a significant news event that can move the market. However, today's economic calendar seems pretty quiet with no major high-impact news scheduled in the morning. But today, there's a bond auction happening in the afternoon, 1 p.m. So, instead of trading earlier in the day, ICT shifted our focus to the afternoon session. Next up, we'll be marking the new day opening gaps, and we'll have 5 of them to work with. If we have a new day opening gap that forms on Tuesday, ICT might mark this as the new week opening gap Wednesday high and date after that. At 7 a.m., we find ourselves trading well above the new week opening gap. But here's something to keep in mind. These gaps tend to have a magnetic effect on the price. Even though we're currently above it, the price could very well come back to these gaps multiple times throughout the session or in another session. In this scenario, we have a gap down where the price closed at 5 p.m. and then opened below it. But if we look closely, we can see that the price moved around the gap, leaving a portion of it unfilled. This unfilled area indicates missing sell-side delivery, which is crucial to note. These gaps, especially when partially unfilled, tend to exert a magnetic pull on the price. We'll place a Fibonacci extension on the gap and add the 0.25 and 0.75 levels to it. We divide the gap into 4 quarters. Interestingly, price within the gap tends to respect these levels. At 7 a.m., we were trading significantly above the new day's opening gap. However, after the bond news was released at 1 p.m., the price eventually filled the entire gap. ICT mentioned that this is gold dust and should definitely be noted. When we have one new day opening gap above the price and 3 to 4 new day opening gaps below, it's a strong indicator that the market is likely to move towards the downside where the clustering occurs. However, remember, this isn't the only factor in determining a bearish market. We need to consider the overall narrative and other price signatures to build a comprehensive view of the market. When referencing 7, 8, and 9 a.m., we analyze what the price is likely to do based on relative equal highs and lows. If the new day opening gap is significantly below the current price, we should anticipate that these highs are likely to be taken out. Consider that above these highs, there's buy-side interest, with buy-stop orders resting there. After 9 a.m., the market may rally, creating small swing highs and relative equal highs. Following this, the price often breaks down, forming another relative equal high. This pattern indicates that the price is engineering liquidity. Now, for those with a deeper understanding and experience from following ICT, we will refer to the previous session's market. We have this low here and another one here. What does it make relative equal low? Do you remember the criteria for choosing high probability or relative equal lows? They should reflect as price is making higher low. That means right one has to be higher than the previous low. This low could be used as a target around that bond auction. Here ICT is showing his trade. He took with narrative aligned with the bond auction. He has taken this trade about 15 minutes before the news. Anticipating at news, algo will push the price down. We have relative swing low from London and new day opening gap below that. This candle traded up, and ICT wanted this candle to be very reactive when it enters into the inefficiency above. This is another important point, and ICT asked us to note it down. Some of the most common questions ICT gets: what will he do? If he is not trading this fair value gap, how did you know price is going to do this and not going to other direction? We're expecting some key news to drop shortly, but before that, let's analyze the current price action. Take a look here. We've just made a lower high, and notice how the body of the candle is respecting the fair value gap. This is a critical area because we're seeing the price start to move down from here. Now, let's shift our perspective as if the price action on the right hasn't printed yet. If we're in this situation, our understanding should be that the price is most likely to target this low here. Why? Because that's where the liquidity is sitting. But before it can do that, remember, the price has been trending down all day. It hit a point here, stopped, then retraced all the way back up before moving lower again. Now, it's crucial to keep in mind what's happening at the bottom. We've got a new short-term low forming, and this becomes our first target if the price is going to head down to that new day opening gap. This low has sell-side liquidity, which is what the market might aim to take out next. So, as always, Watch these levels closely and stay sharp. The market's telling us a story. Our job is to listen and act accordingly. Now, some of you might be noticing the relative equal highs here and wondering if they pose a concern. But remember what ICT mentioned. Those highs shouldn't bother you. The market is clearly moving lower, pulling towards the new day opening gap. Even if the price doesn't trade there during today's session, the focus remains on where the liquidity is. So, what are we left with? It's the sell-side liquidity and the London session's relative equal lows. These levels are key. We now have these three critical points: this low, and this low. Together, they make shorting a high probability move, with the price likely to draw towards them. The alignment of these factors makes it clear that the market's intention is to target these areas. This is a prime moment where we should see the market start to run, especially with the bond auction starting right around here. We're positioned up here, and there's a strong likelihood that the market will take out this sell-side liquidity and potentially target the previous session's relative equal lows. Now, when the price was here, ICT was closely watching to see if the price would go above the fair value gap and touch the midpoint of the gap. The price came pretty close but didn't quite touch it, and then it closed below the fair value gap. This is a clear signal that ICT recognized as the formation of a bearish order block. When the second candle right after the up-close candle touches that up-close candle, that's a strong signal to short. What ICT is looking for here is for the price to move away and then come right back up to this level. It's crucial that this candle isn't overtaken, and the next candle falls short of the one that touched the fair value gap. If that up-close candle had reached the midpoint of the fair value gap, ICT wouldn't have taken this trade. Instead, he would have waited for another candle to move up and reach the remaining inefficiency in that fair value gap. While PD array often used for setting static levels to enter and exit trades, ICT also uses these price levels to measure the market's strength and weakness. For instance, if this candlestick can't even touch the fair value gap, that's a significant signal. This inability to reach the fair value gap is a signature move that indicates potential weakness. When this candle closes, all you need to do is watch for when the price moves away and then comes back to touch the bottom of that candle. This setup forms a bearish order block.
We have target here, as we already know, the sell-side liquidity.
As price comes back to the order block, ICT sells short. Now, ICT often emphasizes observing how price interacts with these gaps, especially when the consequent encroachment of the lower gap hasn't been touched yet. Take a look at the chart. Notice that we've got two fair value gaps, one here and another one higher up. What we need to anticipate is the possibility of price pushing up to fill the higher fair value gap. But what if it doesn't? What if price fails and instead retraces to the lower fair value gap? If that happens, the lower gap's consequent encroachment becomes a critical level to watch. And with a news driver on the horizon, there's an added layer of confluence. However, ICT not shying away from this trade. ICT actually took a position from the order block beneath this fair value gap. Now, ICT wanted to see this upper fair value gap open, and crucially, he wanted to see it fail to reach the midpoint of the lower fair value gap. This is something we need to pay close attention to. If the price had touched that midpoint, then I would be expecting the candle to push into the left inefficiency within this fair value gap. In that case, my stop loss would be placed just above the midpoint of the fair value gap. These are the kind of logics we need to build our trading strategies on. It's not just about reacting to what the market does, but anticipating these key levels and structuring our trades around them. After price dropped, we saw an immediate rebalance. The market traded down, bumped here with that immediate rebalance, and while ICT was taken into a little bit of drawdown on the second portion, he was still profitable at this point. Why? Because he initially shorted 6 contracts, a larger trade, and then added 4 more. Now, price could have reached further into this fair value gap, but ICT wanted this gap to remain open. price did push up to that level, but crucially did not touch the midpoint of the fair value gap. This was a confirmation of our narrative that the algorithm is in a sell program, and price should now target the relative equal lows formed during the London session. At this point, the only thing we needed to do was to move our stop loss to break even and let the trade do its job. When price reached 1 o'clock, we saw exactly what ICT has been teaching us. The algorithm pumped first, catching traders off guard, and then dumped it. ICT mentioned in his last lecture that when we anticipate price to be in a sell program, we need to mark every significant imbalance. Here, we could have had another opportunity. This scenario perfectly illustrates the importance of understanding how the market structure and algorithmic behavior align with our trading models. If this breakdown helped solidify your understanding, then be sure to check the description below. I'm making notes on this that I'll be sharing with you. Don't forget to like, subscribe, and share your thoughts in the comments. Let's keep learning and growing together.
Easy, isn't it?